This is a year in which the inflation outlook is on the highest side. We are also seeing interest rates forming up at the margin. Also, globally, commodity prices are strong. There's a fear of US Fed balance sheet contraction and rise in rates globally. So this is a tricky year from the macro perspective. The second thing is valuations of the broader market, especially of mid-caps, are also quite rich. But at the same time, this is also the year in which earnings finally comes back, earnings growth finally comes back in India. So if you look at this overall construct, two things clearly stand out. One is that one should expect subdued returns from the market, although hopefully not negative because of the earnings growth. The second thing is the divergence between mid-cap valuations and large-cap valuations is very stark. I think earnings growth could be as strong in large caps as in mid caps. So from a market cap perspective, very clearly large caps are preferable this year over mid caps. We are of course bottom up investors, but the stark difference in valuations makes it a very easy call to make. Thirdly, I think some of the very ignored sectors like IT services, especially given the global growth coming back, especially in the US, could stand out this year. This is a sector which has not performed for a very long time, and growth seems to have bottomed out in this sector. So earnings growth recovery, coupled with very, very attractive valuations, might make it a good sector to invest in incrementally. Apart from that, you will continue to make money in domestic financials, especially the retail-oriented ones, and specific corporate banks where the turnaround story will start to play out. Specific metal companies will do well. So would domestic consumption. The red herring in the pack could be revival in the rural and broader mass general consumption story, which is essentially FMCG, where growth has not been good. Growth has been tepid for the last few years, and hopefully with this year's budget, growth could come back in any case. So there are a broad variety of mutual funds in India, and it's always a difficult call to choose between them. But this year, one thing is very clear, given that the divergence between performance of mid caps and large caps so far in the last couple of years, the opportunity set is more skewed towards large caps. So I think one should have a bias towards large cap mutual funds this year, very clearly. That will definitely give you better performance. Two other categories stand out for me. The second is, given that you are entering markets now at expensive valuations and you do not have too much of valuation support, you do not have too much of room of safety on that front, you have to increase your investment horizon to make up for the possible PE contraction that can happen in the funds, in the underlying portfolios that you're going to buy. Keeping that in mind, it will be important to come into locked-in funds. So I'd suggest that ELSS funds, which have a natural lock-in of 3 years, would be another great category to look in. For conservative investors who are also quite concerned about preserving capital, who do not want to see let's say 10-15% drawdown in the invested capital, I would also recommend looking at dynamic equity funds this year, because dynamic equity funds clearly can straddle this entire volatility in markets which can happen this year very well, because they allocate or they calibrate their equity allocation according to the market outlook, according to valuation. So if and when the correction happens, they will buy more, increase the allocation, and when the market is very frothy like it is right now, they will cut down on allocation. So I think these are the three categories: large caps, then the ELSS ones, the tax saving ones, and the third would be the dynamic equity funds. These are the three categories to look at for investing this year.